Robert Clementi from Television Education Network, and this is Taxbites. And for Taxbites this week, we're talking about year-end tax planning. It's something we'll talk about a couple of times before the 30th of June. With me is Steve Holmes from WMS on the Gold Coast. Steve is one of our best-known presenters and one of the best experts on tax planning in Australia. And I wanted to talk to Steve today about the issue of corporate beneficiaries following the Commissioner's announcement that subtrusts can no longer be used. Steve, what implications does this have for tax planning and the use of corporate beneficiaries?
Yeah, thanks, Rob. Excellent question. In light of the Commissioner's draft announcement 2022 D1, where he's just thrown out the practice statement from 2010 saying, look, from 1 July 22, we're not going to accept subtrusts anymore. We're going to require you to, if you distribute to a company from a trading trust or any trust, in fact, we want that unpaid distribution dealt with under Division 7A pretty much immediately. So the change for us, for those clients who were using subtrusts, and we've used them quite widely, is that we're going to have to change the client's script that if they're using that money that's been distributed to the company to reinvest in their business in the trust, there's a day of reckoning because the Commissioner's now put a time limit, a 7-year P&I approach, and we can't use the subtrust with that, as you may recall, we're interest only anymore. And so I'm finding, even though we're allowed to use subtrusts for distributions this coming 30 June for one last time, the conversation with clients is now, look, guys, we can use corporate beneficiaries still, they're still very, very valid, but the script's got to change that over time, the corporate beneficiary will eventually become a wealth accumulation vehicle if you want to keep having the benefit of the corporate tax rate. In other words, you send the money there, it's invested in assets, whether they're capital appreciating assets, doesn't really matter, but at the end of the day, to keep this company tax rate in your group and invest that 70 cents or the 75 cents you've left after paying company tax, you need to keep the money in the company. That changes the script dramatically, where clients were reinvesting in their trusts using subtrusts, just paying interest. And even at the end of the subtrust arrangement, the Commissioner kept extending, and then we got another 7 years at the end. This new announcement really does need to change the way you engage with your clients on how the corporate beneficiary plays a role in their structure. And I sell it very crudely as, think of your corporate beneficiary as it's like a super fund, but it's not taxed as well as a super fund, and it's nowhere near as brilliant. But if you want to retain profits in there that are invested in assets that are income producing, and you don't pull those out till you retire, you've actually had a really good win. So that's the battle as an accountant. We try and balance up getting money there, keeping the taxman happy with Division 7A, and accumulating assets or loaning back using Division 7A terms. But ultimately, our corporate beneficiaries will have to have assets in them way quicker than we're used to. And that's something, as an SME practitioner, I need to come to terms with this year and get my clients educated with that change. And as I said, that's a massive, massive change.
Steve, thank you very much. That's very good advice. And that concludes this week's edition of Taxbites. Steve Holmes, thank you very much once again. And to our audience, thank you very much for listening.
Most welcome, Rob. Thank you.